In this lecture, we will use the supply and demand analysis to analyze and understand changes in industries and changes in markets. To get us started, let's consider the power generator market in the United States in the decade leading up to the Y2K scare. From 1990 to 1998, sales of portable power generators grew slow and steady at about 2% per year. And then in 1999, as widespread fear of a Y2K power outage spread across the nation, demand for portable power generators skyrocketed. And one portable generator firm, Walters, Rosenberg and Matthews, WRM for short, decided to invest to increase their capacity and their production ability in anticipation of this increase in demand. One of the things they did to increase capacity was to vertically integrate their firm. They vertically integrated this, increased their capacity, reduced their variable expenses, and positioned them to capitalize on this increase in demand for the portable power generators. And in fact, demand grew exactly as they anticipated. Industry shipments almost doubled. They were up by 87%. Prices also increased by an average of 21%. And so it would seem that WRM did everything right to position themselves to capitalize on this increase in demand. But in fact, their Y2K strategy proved to be their undoing. They increased production capacity, but it turned out that in 1999 and in 2000, once the Y2K scare passed without anything but a fizzle, demand fell. As demand fell, the prices tumbled, and WRM, along with about half of the firms in their industry, declared bankruptcy in 2000. Now, the purpose of this chapter is to give you some tools in not only understanding demand and supply, but using those to make economic decisions. Some of this simple information and analysis would have helped WRM perhaps avoid bankruptcy. Some of the main points are the following. Demand curves describe the behavior of buyers and tell you how much will be bought at a particular price, while supply curves describe the behavior of sellers, tell you how much will be sold at a particular price. Demand curves and supply curves are ways to graphically illustrate the underlying behavior of the buyers and sellers in the market. The market equilibrium is the price at which the quantity demanded equals the quantity supplied. If the price is above the equilibrium price, there are too many sellers which will force the price down, and vice versa. The market equilibrium is the price at which the quantity supplied equals the quantity demanded. At the market equilibrium price, there's no pressure for that price to change because the demand and the supply are already equal. The idea of an equilibrium is that there's no inherent incentive for prices to move up or down. It's a steady balancing point, at least until something in the economy or industry or market changes. Graphically, an equilibrium in a competitive market can be identified as the intersection of the supply curve and the demand curve. In a competitive equilibrium, there will be no unconsummated wealth-creating transactions. The price mechanism will convey the behavior and the values of the buyers to those of the sellers and vice versa, and the equilibrium point will be that point at which every buyer can find a seller and vice versa at a price point that they both agree and are willing to pay. Let's consider an example with some numbers. Prices running from $4 to $12, a downward sloping demand curve supported by an underlying demand schedule that captures the number of buyers at any given price point, and an underlying supply schedule that captures the number of sellers at every price point as well. We can see that the demand curve and the supply curve in our illustration on the left simply illustrate or graph the price points in the demand schedule and the supply schedule, and that the market equilibrium is that point of intersection, the $8 price at which the quantity demanded and quantity supplied are both equal to 5 units. There is neither an excess nor a shortage. Now, when we talk about a change in demand or an increase in demand, what that means is that at any given price point, more quantity is demanded. If we say have an original demand curve illustrated here in orange, and at every given price point increase the demand by 4 units, what will that do, or what will that look like? It will look like a rightward shift in the demand curve. If we consider the price point of $8 that we were looking at a little bit a moment ago, that price point of $8 originally had 5 units demanded. If the demand curve shifts 4 units to the right, then at every price point, demand will go up by 4. And so at the $8 price point, the quantity demanded, or the number of units demanded, has gone from 5 to 9. This shift in the demand curve is referred to as a change in demand, in this case an increase in demand. Supply curves and demand curves can be used to understand what will happen to market prices and market quantities when there is a change in the underlying demand or the underlying supply. Let's look at our original example where the original equilibrium price was $8 and the original equilibrium quantity was 5. What happens to the price and quantity in equilibrium when the demand shifts to the right or increases by 4 units at every price point, which is illustrated by the movement of the demand curve from the original orange to the new black? We can see that the new intersection occurs at a higher price and a higher quantity. There's an increase in the quantity supplied, which tells us that there's been a movement along the supply curve. The mechanism driving the price to the new equilibrium is the competition among buyers to buy and sellers to sell. In this case, we had an increase in demand, an increase in the quantity supplied, and the new equilibrium price occurs at a price point of $10 and a quantity of $7. Let's go back to the portable power generator market that we were talking about a few moments ago. In 1997, the market was experiencing stable growth, about 2% average annual growth. Then, in anticipation of the record growth in 1999, the industry expanded dramatically. WRM and others invested in their infrastructure, vertically integrated, which drove down costs. What happened, or how we can illustrate this investment by firms will occur on the supply side. What happened on the buyer side will be illustrated via the demand side of the equilibrium. This graph shows us exactly what happened both on the demand and supply side in the run-up to 1999. Point A represents the original equilibrium price and quantity in 1998. Two things happened. In 1999, suppliers increased their capacity, which is illustrated by a rightward shift of the supply curve. In addition, buyers dramatically increased their demand, illustrated in a rightward shift of the demand curve. So by the time 1999 was underway, the equilibrium point had changed from A to B. We had a new demand curve and a new supply curve. Demand had increased and supply had increased. And we can see that the unit sales, or the number of units sold, increased dramatically. That's measured on the horizontal or quantity axis. The price also increased, we can see, went up vertically a little bit, but not nearly as much in percentage terms as the quantity. And that squares with the data we were presented. An 87% increase in sales, a 21% increase in price. Then what happened in 2000? Well, the sellers had expanded their capacity, which was a more permanent investment. So the supply curve stayed at its new rightward shifted level. The increased supply or increased capacity remained after the Y2K scare evaporated. Demand, on the other hand, fell back to 1998 levels, and what that meant from an equilibrium standpoint was that we moved from point B to point C. Point C is the intersection of the original demand curve with the new supply curve, representing increased supply, but demand that fell back to the original levels. And we can see that although the quantity was still somewhat above the original level, the price had declined dramatically. And that dramatic reduction in price eroded the profit margins and led to the widespread bankruptcies in this market. Another simple illustration is the following. Over the past decade, the price of computers has fallen dramatically while the quantity has risen. Now, simple supply and demand analysis can help us to infer whether this is driven primarily by demand or supply side changes. In this case, the only way we can really explain a reduction in price and an increase in quantity would be through an increase in the supply curve, and that primarily reflects the reduced costs of production among the suppliers of computers. Over time, they've been willing to supply more and more units at any given price point. That's led to, as we can see in this illustration, an increase in the quantity from Q0 to Q1 and a decrease in the equilibrium price from P0 to P1. Prices are the primary way that market participants communicate with one another. Buyers signal their willingness to buy and sellers signal their willingness to sell through the price mechanism. Price information is extremely important in market economies and in particular financial markets, where the value of buyers and sellers is communicated primarily through the price mechanism. The price mechanism can also help us to understand and explain changes in demand, changes in supply, and changes in prices in actual markets. Consider the gas pipeline that runs from Tucson, or runs from El Paso through Tucson to Phoenix. Arizona has no refineries of its own. It has two major pipelines, and this one was from El Paso through Tucson to Phoenix. When a gas pipeline burst near Tucson, it eliminated a major supply source for gas in the Phoenix area. What happened to the gas price in Tucson, or in Phoenix, or in Los Angeles? Supply and demand analysis can help us to understand what happened. The supply in Phoenix obviously went down. Now we can illustrate that with a leftward shift of the supply curve in our supply and demand analysis. In fact, the supply went down pretty dramatically when this gas leak occurred, and the prices of gas in Phoenix increased. Now they increased to such a point that truckers actually started driving from Phoenix down to the rack in Tucson, waiting in lines to fill up their rigs and drive them back to Phoenix. The price differential was that high. In that case, the price mechanism was conveying to the truckers that gas was much more valuable in Phoenix than Tucson, created an incentive for the truckers to go down and pick up some of that gas and truck it back to Phoenix. Now the overall impact was still a reduced supply, prices went up. But that behavior by the truckers also reduced the supply of gas in Phoenix, or in Tucson, and so we saw a price rise in Tucson. The reduced supply, or the reduced overall supply, also impacted cities as far away as Los Angeles, where we also saw a reduced supply, and as a result, in the equilibrium setting, we saw that the prices went up and the quantity, the equilibrium quantity of gasoline consumed in all three of those cities went down, as we can see illustrated on this graph. It was not until the pipeline was restored and the equilibrium quantities were able to return to their original level, prices then falling and consumption levels rising back to the original level. The main points here are that market demand describes buyer behavior and market supply describes seller behavior. If a price changes, then we illustrate this as a change in the quantity demanded, an increase or decrease, which is represented by a movement along the demand curve. If anything or any factor other than the price changes, we represent that with a shift of the demand curve, either to the right or to the left. Supply curves describe seller behavior, how much will be sold at a particular price, and the market equilibrium is the price at which the quantity supplied equals the quantity demanded. If the price is above the equilibrium price, this means there are too many sellers. Competition among buyers and sellers will force the price down, and vice versa. I want to thank you for listening to this lecture on supply, demand, and its application to industries and markets.